We got some pretty weak U.S. jobs numbers today, but our guest says short-term data secondary to geopolitics and increasing concerns over inflation. Let's get now to Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thanks very much for joining us. Give us the rundown of these U.S. job numbers. What do you think was the important thing here, please?
Yeah, good morning. Yeah, the U.S. Job numbers were very disappointing, I think surprising to everyone in the market. And if we didn't have the geopolitical activities going on that we're seeing now, we would have seen a significant rally, a significant readjustment for eases. You know, the market in the U.S. is discounting 1 to 2 eases. It wouldn't surprise me if we moved to 3 to 4, just given that number alone. The reason why we haven't, however, is because we like to look at things as tides and waves. The employment number today is a wave. Any data right now is a wave. The tide right now is the Middle East, and more specifically, oil and the price of oil and the important implications of inflation on bond yields, on asset returns, and most importantly, monetary policy is what's driving markets right now. So with the move that we saw in oil overnight, there's a lot of uncertainty as to whether or not we will be heading towards an inflationary boom, which was kind of our underlying assumption heading into this year, or an inflationary bust. We still believe we'll see an inflationary boom, but it's going to be about, let's call it 6 months before we know if that changes, if the inflation in oil goes into inflation expectations. But yeah, that's the way we're looking at the market now. We're still buying risk assets at this moment, but we are underweight duration.
Underweight, meaning you're avoiding longer-term bonds because of inflation concerns?
Yeah, not just avoiding them, selling them.
Okay.
Because we feel that the inflation risk is being underestimated by the market. Why do we say that? You know, you could say we've seen a 10% move in oil overnight, but break-even inflation, which is the markets, how markets look at inflation, has only moved, call it 1%. So we feel there's an underestimation of the risk of inflation. Although we don't think it'll go out of hand or be extended, we're still preparing for that.
Maybe we could have a look at a 5-year chart showing the U.S. 10-year bond yield. Of course, in times of crisis, people are inclined to buy government bonds, and this Middle East situation has distorted
that is not fully true. In times of crisis, people buy bonds when inflation is not an issue.
Okay.
When inflation is an issue or a highlight, people don't tend to buy bonds. That's why bond yields are approximately 20 basis points higher than they were last Friday. So that's an important caveat there to note. The other thing in looking at this chart, the range, and I'm not sure if you're showing Canada or 10 years, but U.S. 10-year bonds last year, the range was 390 to 480. Right now, let's say we're at 415. That's below the midpoint. That's why we think it's actually a good hedge to be underweight duration, because we believe we could test above the midpoint where we start buying. That midpoint's 435. So we do think the yield has a way to go on the upside. It provides a good hedge in this market environment. But at those levels, we start buying bonds.
That's interesting. So inflation really is a threat here because higher energy will feed through the system. It'll give companies an excuse anyway to hike prices.
Yeah, so let me walk through this a little bit from a central bank mentality perspective. Inflation driven by this oil price spike right now is not a threat. It's a supply shock. And monetary policy will look through that. So they will still ease one more time, despite oil being where it is right now, because they'll say this is a supply shock. Easing won't impact the supply. So we feel we need to ease because of what's going on in unemployment, what's going on in the economy. So they could ease once. Where it starts impacting central bank decision making is if it goes into inflation expectations of the population. And what that means is if someone's going to their gas to put in gas once a week and they see the price jumping 10% every week, all of a sudden they may think, oh, this inflation is going to go beyond gas, the inflation expectation of the future, and they start hoarding. They start buying goods now, groceries, because they're fear the price is going to go higher. That's what central bankers don't want to see. We don't anticipate that will happen. And for that to happen, if it does, will take at least 6 months. So that's why we're comfortable buying risk assets now. We believe the big, beautiful bill is still in effect. The tax receipts being received over the next 3 months will be support for the U.S. economy and North American economy. And we also feel the deregulation moves going through in the U.S. will impact business owners, small and medium size, which will be an underlying support to job growth there. So we're still constructive. We feel we're looking at this as an opportunity, but we're doing this with an awareness that the wild card is the time of how long this war could go on.
When you say buying risk assets, what do you mean specifically there?
So specifically for us, we're buying high yield bonds. We bought high yield bonds this week twice, and we'll probably buy potentially today, but next week if we continue to get the sell-off. So from a broader aspect, risk assets is equities, but we don't participate in equities. But we see it as an opportunity to get those at better prices than you could have last week, because we still believe in the underlying drivers of growth in the North American economy.
That's interesting. You think Canada is, our growth has been sluggish, but you think Canada will manage some kind of an increase in output this year?
Yeah, we always benefit from the U.S. doing well. So that's the number one driver. What's interesting now with Canada, we're buoyed from or supported by commodities, right? With commodity prices going up, as they said, with us being a safer sort of oil partner, there's a lot of there's a lot of reasons to be constructive on Canada, although we do expect it to still be sluggish and lag the U.S.
Right. And I'm just looking just on this the weak U.S. jobs report. Partly this was fueled by healthcare employment suffering due to strikes. So I guess these 1 month that was part of it anyway. So you have to be...
and the other part too, the weather could have impacted it, because if you look at the breakdown of the U.S. number, you could see manufacturing, construction was down, but more importantly, you could see leisure and hospitality was down. So that could have been weather impacted as well there too. So, we never look at one report on a standalone basis. You have to look at the trend. The trend is negative. It's not positive. The average job growth's going down and stuff, but you have to look at it over time, at least a minimum 3 months.
Earl, thank you very much indeed.
You're welcome.
Earl Davis, head of fixed income and money markets at BMO Global Asset Management.